My last video on why low-interest debt isn't always bad sparked a surprising reaction. Not just views, real conversations. People emailed me, they stopped me after meetups, and some even messaged me screenshots of their loan dashboards at 2 a.m. Almost everyone asked the same thing. Okay, I understand how debt works now, but what do I actually do with my extra money? Should I invest it, or should I kill the loan as fast as possible? Because on one hand, investing feels smart. On the other hand, debt feels heavy. And that tension, that mental tug of war, keeps people stuck for years. So today, we're going to break this down calmly, logically, and honestly. No hype, no guilt, no one-size-fits-all advice. Just a framework I call the F2 rule, the Freedom Fund rule. Let's start with a situation that feels uncomfortably familiar. You bought a home with a 30-year mortgage, a $480,000 loan at 7%. Your monthly payment is about $3,200 for principal and interest only. After a year, something good happens. You get a raise, or maybe your side income grows. Now you have $1,000 extra every month, and suddenly you freeze. Do you throw that money at the mortgage, or do you invest it and let compounding do the heavy lifting? Either choice feels risky. Paying the loan feels slow and boring, while investing feels smart but uncertain. So let's walk through both paths. In the first path, you decide to invest the extra $1,000 every month into a broad market index fund. You stay disciplined with automatic contributions and no panic selling. Let's assume a 9% long-term annual return, and that your contributions grow 3% each year as your income increases. Over the remaining 29 years of your mortgage, that investment grows to roughly $1.8 million. On paper, this looks incredible. This is why investing Twitter exists, and why people say never pay off low-interest debt. But this is only half the story. Here's the uncomfortable truth about loans that no one explains properly. In the early years, you barely own anything. Your payment feels large, but your progress is tiny. In year one, you might send the bank over $38,000, and your balance drops by only a few $1,000s. The rest is pure interest. That's not a scam, it's amortization. Banks get paid first, and you get equity later. And that's what leads us to the second path. Path 2. Aggressively pay down the loan. Now imagine you send that $1,000 straight to principal every month. Not interest, not fees, principal. Every extra dollar immediately shrinks the loan. Do this consistently, with small annual increases. Your 30-year mortgage is gone in about 16 years. You save hundreds of thousands in interest. That's a guaranteed return equal to your interest rate. At 7%, that's powerful. No volatility, no headlines, no market crashes. But there's a catch. That money is locked inside your house. You can't swipe home equity at the grocery store. So which path is right? Why the math alone lies to you? If we compare totals, invest-only strategy, slightly higher net worth. Pay-off first strategy, lower total, but zero debt much earlier. Investing wins on paper, but paper doesn't feel fear. Paper doesn't wake up at 3 a.m., and paper doesn't account for sequence of returns risk. You could invest perfectly and still hit a bad decade early. With debt payoff, returns are guaranteed, predictable, and emotionally stabilizing. Which brings us to the real solution. The F2 rule, the Freedom Fund rule. The mistake is thinking this is a binary decision. It's not. The F2 rule says split your extra money between future growth and present freedom. Because wealth without peace isn't wealth, and peace without flexibility isn't freedom. Practical ways to apply it. 50-50 split. Half to investing, half to prepayment of loan. Age-based split. Younger, invest more. Older, pay debt faster. Interest rate rule. Above 8%, prioritize payoff. Below 4%, prioritize investing. In between, do both. This isn't about perfection. It's about alignment. When paying off debt makes more sense. high-interest loans, unstable income, near retirement. Debt causes real anxiety. Peace is a return, too, just not one spreadsheet's measure. When investing makes more sense. Very low-interest loans, strong emergency fund, retirement accounts not maxed, long time horizon. Liquidity creates options. The real question isn't financial. Two people can have the same mortgage. One feels empowered, the other feels trapped. Same numbers, different stories. That's why the F2 rule isn't about math. It's about designing a life you don't want to escape from. Final thought. There is no universally correct answer. There's only a deliberate answer. If you choose intentionally, with awareness of risk, emotion, and goals, you're already ahead of most people. Because personal finance isn't about winning a spreadsheet. It's about building a life that actually feels free. And yes, I'm still deciding what to do with my own extra $1,000 this month too. That never really stops.
There's one more layer to this decision that almost nobody talks about, and it has nothing to do with interest rates, returns, or spreadsheets. It has to do with behavior, because the biggest risk in personal finance isn't market volatility. It's you. Why perfect math fails real humans. Here's the uncomfortable truth. Most people don't invest the way spreadsheets assume they do. The spreadsheet assumes you invest every month, you never panic, you never stop, and you never sell at the bottom. Real life doesn't work like that. Let's be honest. When markets crash 30%, most people don't say, great, stocks are on sale. They say, what if this time is different? They pause contributions. They hesitate. Sometimes they sell. And once that happens, the beautiful 9% average return stops being real. Meanwhile, mortgage prepayment doesn't require discipline. Once the payment is scheduled, it just happens. No emotions, no headlines, no second guessing. That's why two people with the same strategy get wildly different results. Not because of math, because of behavior. Liquidity, freedom, or illusion. Now let's talk about liquidity. People often say, don't lock money into your house. You lose flexibility. That's partly true, but here's the flip side nobody mentions. If all your wealth is invested and your job disappears, you still owe the bank next month. Stocks don't cancel mortgage payments. A paid off or partially paid down home lowers your monthly burn, reduces stress during layoffs, gives you negotiating power with life. Liquidity gives flexibility, but low expenses give resilience. Both matter. That's why the F2 rule exists. The invisible return no one calculates. There's a return nobody models. Confidence. When your debt is shrinking faster than scheduled, something changes. You take smarter career risks, say no to bad jobs, negotiate harder, sleep better. That confidence compounds too. Not on a chart, but in your life. And ironically, people who reduce financial stress often earn more over time. Not because of numbers, because they think clearer. The all or nothing trap. Most people fail not because they choose wrong, but because they go all in emotionally. They tell themselves, if investing is better, I must invest everything. Or, if debt is bad, I must eliminate it immediately. That mindset creates regret. When markets fall, investors panic. When life expenses rise, debt killers feel stuck. The F2 rule avoids this trap. It gives you progress on both fronts. Momentum without fragility. A simple way to apply this starting today. Here's a clean, realistic approach. Build a solid emergency fund, capture any employer match, pick a split you can sustain for years, not months, automate both sides, and reevaluate once a year, not every market headline. That's it. No constant tinkering, no emotional overreaction. The quiet advantage of boring consistency. The most financially successful people don't make brilliant moves. They make boring decisions and repeat them for decades. They don't chase returns. They don't race debt. They design systems. The F2 rule is a system that balances growth and safety, freedom and flexibility, logic and psychology. Final reflection. Ask yourself this: which choice helps me live better today while still building tomorrow? If your answer is investing more, great. If your answer is paying down debt, also great. If your answer is both, that's wisdom. There is no trophy for fastest payoff. There is no medal for biggest portfolio. There is only the life you experience along the way, and the goal was never to be the richest person on paper. The goal was to feel free while you're alive. That's the real return.
By now, I know exactly what some of you are thinking, because my inbox filled up with these same objections the last time I talked about this. So let's do this properly. Let's address the toughest questions head on. Isn't paying off a mortgage early financially dumb? This is probably the most common comment, and it sounds smart because mathematically, over long periods, stocks tend to outperform mortgage rates. But here's the problem with that sentence. Tend to is doing a lot of work. Markets don't pay averages, they pay sequences. If your best returns come late and your worst returns come early, your real life outcome can be very different. Mortgage payoff doesn't care about timing. A 7% loan paid down early is a guaranteed 7% return every single time. Not dumb, just different. What about inflation? Doesn't inflation eat debt? Yes, inflation reduces the real value of debt, but only if your income keeps up. If inflation runs at 5% and your wages grow at 2%, debt doesn't feel lighter. It feels heavier. Inflation is only your friend if your cash flow is strong and stable. That's why paying down debt can actually be a hedge against personal inflation. Why not just invest, then pay the mortgage later? This sounds elegant in theory, but it assumes three things. Markets cooperate, you never lose your job, and you have the discipline to switch strategies later. Most people don't. Life interrupts. Kids, health, layoffs, burnout. The F2 rule works with reality instead of assuming it away. Isn't home equity dead money? Only if you measure life purely in spreadsheets. A paid down home lowers required income, increases negotiating power, reduces desperation. You can't measure that in IRR, but it shows up in decisions you don't regret later. What if I regret not investing more? You might, just like you might regret paying debt faster. Regret is unavoidable. The goal isn't to eliminate regret. The goal is to avoid catastrophic regret, the kind that keeps you stuck, stressed, or forced into bad decisions. Splitting your strategy reduces the extremes. Okay, so what's the one rule I should remember? Here it is. Optimize for staying in the game. The best strategy is the one you can maintain through market crashes, job changes, life chaos, not the one that looks best in a spreadsheet screenshot. A simple reality check. Ask yourself, would a market crash make me panic? Would debt-free living change how I work? Do I value flexibility more than certainty, or certainty more than upside? Your answers matter more than my math. Why the F2 rule works long term? Because it respects human psychology, uncertainty, trade-offs. It gives you growth without fragility, security without stagnation, and most importantly, it gives you choice. Closing thought. If personal finance had a final exam, the question wouldn't be which strategy made the most money. It would be which strategy helped you live better, because money is a tool, not the score. And the F2 rule isn't about winning the game. It's about staying free while you play it.
There's one final mistake people make with this decision. They treat it like a math problem, but it's actually a life strategy. The timeline illusion. When you're 25 or 30 years feels abstract. A mortgage feels like future me's problem, but time moves faster than you think. Suddenly, you're 40. Your priorities shift. Stability matters more than upside. Energy becomes more valuable than money. And here's the part nobody tells you. The best financial decisions often change over time. What was optimal at 28 may be stressful at 42. That's why flexibility beats perfection. Why extreme strategies backfire. People who go all in on investing often say, I'll deal with debt later. But later comes with kids, aging parents, burnout, health costs, and suddenly volatility isn't exciting anymore. On the flip side, people who go all in on debt payoff sometimes wake up at 45 with a paid-off house, very little liquid wealth, and regret about missed compounding. Extremes feel decisive, but they quietly limit your future self. Freedom is optionality. Here's a powerful reframe. Freedom isn't money. Freedom is options. Options to quit a bad job, take a pay cut for meaning, move cities, start something risky, slow down. The F-squared rule creates options on both sides. Investments equals flexibility. Lower debt equals resilience. You're not betting everything on one future. You're building multiple exits. The silent win no one brags about. You'll never see this on social media. No one posts, just slept peacefully because my expenses are low. No one tweets, didn't panic today because my risk is balanced. But those quiet wins compound. They show up as better decisions, calmer relationships, longer careers, healthier lives. That's real wealth. A question worth
sitting with. Instead of asking, which strategy makes the most money, ask, which strategy makes me harder to break? That answer changes everything. Design before optimize. Most people optimize numbers before designing life. Flip it. Decide how much stress you can tolerate, how much uncertainty you want, how much freedom you need. Then let the math serve that vision, not the other way around. The F-squared rule. It's not anti-investing, anti-debt, anti-math. It's anti-fragility. It assumes markets wobble, life gets messy, humans aren't robots, and builds around that reality. Final closing. Strong end screen moment. At the end of the day, no one remembers your net worth chart. You remember how trapped you felt, how free you felt, how much control you had. Money is just leverage. Use it to buy freedom, not anxiety. And if you're still unsure what to do with your extra $1,000, good. That means you're thinking, and thoughtful people tend to do just fine in the long run.
There's one angle we haven't talked about yet, and it's the one that matters the longest: legacy. Money outlives your spreadsheets. One day, none of this math will matter to you, but it will matter to the people who live in the life you built. Your kids, your partner, your future self. They won't inherit your CAGR. They'll inherit your structure. What financial habits really get passed down? Kids don't learn money from numbers. They learn it from stress levels, conversations at the dinner table, how often money causes arguments, how safe or unstable life feels. A household with lower debt but steady investing teaches balance. A household obsessed with optimization teaches anxiety. A household drowning in debt teaches fear. Your strategy becomes a lesson, whether you intend it or not. Why a paid-down home is still powerful. A paid-off or low-debt home does something subtle. It anchors a family. It creates continuity, safety, optionality across generations. It's not about bragging rights. It's about having a base. And from that base, investing becomes calmer, smarter, and more patient. The investor identity trap. Some people don't invest for returns. They invest for identity. Being the investing person feels smart, feels modern, feels superior. But identity-driven finance is fragile. The market doesn't care who you think you are. The F-squared rule avoids this trap by separating ego from strategy, identity from outcomes. You don't need to prove anything. You need to build something that lasts. What wealth actually does over generations. Real wealth doesn't explode. It stabilizes. It reduces chaos. It shortens recovery time. It gives the next generation a longer runway. The families that win long-term aren't the ones with the highest returns. They're the ones that avoid financial resets. The ultimate reframe. Instead of asking, how do I beat the market? Ask, how do I make sure my family never has to start from zero? That's the real game. Why the F-squared rule is generational. Because it builds assets, reduces risk, lowers dependence on perfect outcomes. It doesn't require genius. It requires consistency. And consistency is teachable. Your final choice isn't financial. At the end of all this, you're not choosing between investing or paying off debt. You're choosing stress versus stability, fragility versus resilience, ego versus peace. The math is secondary. Final words. End of series close. The goal was never to die with the biggest number. The goal was to live and leave a life that feels solid. A life where money supports decisions, not controls them. The F-squared rule isn't a shortcut. It's a philosophy. Build growth, build safety, build freedom at the same time. That's how wealth survives. Let me leave you with something simple. After all the math, after all the scenarios, after all the opinions, there's only one real mistake you can make: not choosing intentionally. Most people drift. Winners decide. Most people don't choose a strategy. They drift. They invest sometimes, prepay sometimes, react to headlines, follow whatever feels urgent this month. That's not a plan. That's financial autopilot. And autopilot works fine until turbulence hits. Freedom isn't a destination. People think freedom arrives one day, when the house is paid off, when the portfolio hits a number, when I finally feel safe. But freedom isn't a finish line. It's a direction. Every intentional decision moves you closer or farther away. The F2 rule points in one direction only, toward optionality. Why this question never fully goes away. Here's the truth nobody tells you. Even when you earn more, you invest longer, you know more, this question doesn't disappear. You just ask it at higher levels. Do I invest more or buy time back? Do I chase growth or protect peace? That's not failure. That's adulthood. What mature finance looks like. Mature finance isn't about maximum returns, perfect timing, bragging rights. It's about
about durability, calm decision-making, not panicking when life hits. The richest-looking strategy often isn't the strongest one. The strongest one is the one that survives stress. Your one takeaway, if you forget everything else. If your strategy helps you sleep, keeps you consistent, reduces bad decisions, it's a good strategy, even if it's not optimal on paper, because paper never had to live your life. A quiet test you can run. Ask yourself this tonight. If the market dropped 40% tomorrow, would I panic? If my income paused for 6 months, would I feel trapped? If either answer worries you, adjust your balance. That's wisdom, not fear. The final truth. There is no universal best move. There is only your risk tolerance, your life, your definition of freedom. The F2 rule doesn't tell you what to choose. It gives you permission to choose without guilt. Last line. Mic drop ending. Money is supposed to serve your life, not test your nerves. Build growth, build safety, build freedom at the same time. That's the whole rule. That's the whole game.